Welcome to The Explainer. Today, we're doing a deep dive, a masterclass, if you will, on one of the most powerful financial tools in the world, the S&P 500.
You've definitely heard the name kicked around, right? On the news, they'll just say a number. The market is up today, and that's usually what they're talking about. It's the benchmark everyone, and I mean everyone, from Wall Street traders to your uncle at a barbecue, seems to mention.
But here's the thing. It's so much more than just a number. What if I told you it's also one of the simplest, most direct ways for pretty much anyone to own a piece of the biggest companies in America? Yeah, this one tool has totally changed the game for modern investing. All right, let's get right into it. We'll start at the beginning. What is this thing, really, that we hear about all the time? So the Standard & Poor's 500, the idea is simple. It's not a single stock. It's more like a VIP list of corporate America, tracking the performance of 500 of the biggest publicly traded companies in the US. The version we use today kicked off back in 1957, and it's all about gauging the health of these large-cap companies, the absolute biggest players in the game. And this isn't just some random list either. We're talking about a group of companies so massive, so influential, that together they represent about 80% of the total value of the entire US stock market. Think about that. When you're looking at the S&P 500, you're looking at a huge, huge slice of the American economic pie. And that's why people call it the market's report card. It's so broad, covering everything from tech to healthcare and beyond, pretty much every major part of the economy. Because of that, its performance is seen as the best single snapshot we have of the U.S. stock market's overall health. Is it having a good day or a bad day? The S&P 500 will tell you. So let's take a quick look back. This thing didn't just appear out of nowhere. It actually has a pretty cool history, and its evolution really mirrors the story of the American economy itself. You can really see the journey here. It started way back in 1926 as a much smaller index, just 90 companies. Then, boom, 1957 is when it becomes the S&P 500 we know. But honestly, the most important date for most of us is 1976. That's when the first index fund was launched, which basically meant regular people like you and me could finally invest in it easily. And then later, in '88, it got even smarter, becoming dynamic so it could change as the economy changed. Okay, history is great, but why do people care so much? Well, let's talk performance. This is really where the S&P 500 earned its stripes. The numbers speak for themselves. Check this out. Since it started in 1957, the S&P 500 has returned, on average, about 10% a year. Now, that's with dividends reinvested. Of course, some years are up, some are down. It can be a roller coaster. But over the long haul, that consistency is just, wow, it's pretty incredible. And to put that 10% number into perspective for you, that's enough to roughly double your money every 7 years. That's the power of compounding in action. I mean, that's the kind of engine that has been quietly building wealth in retirement accounts for generations. And this right here is a huge reason why it's so beloved. It's not just that the returns are good, it's that they've historically been better than most of the highly paid experts. Over the long run, like 15 years, a super simple, low-cost S&P 500 fund has beaten the pants off the majority of professional stock pickers who are trying to outperform the market. It's kind of mind-blowing when you think about it. All right, so this all sounds pretty compelling, right? But how do you actually do it? How does this concept of an index become something you can own? Let's get practical. Well, the great news is it's actually way easier than you might think. All you need is an investment account. You might already have one, like a 401k through your job or an IRA. From there, you just pick an investment fund whose only job is to mirror the performance of the S&P 500. That's it. And you basically have two popular flavors to choose from. There are ETFs, or exchange-traded funds, which you can buy and sell throughout the day, just like a regular stock. And then there are traditional index mutual funds, which are priced just once at the close of the market. Honestly, both are incredible, super low-cost ways to own a piece of all 500 of those companies with just one click. So let's just recap the magic here. With one purchase, you get instant diversification. The fees, they're often so low, they're practically free. It's incredibly simple because you don't have to worry about picking the right stocks. Plus, it's easy to buy and sell, and it's tax efficient. It's no wonder this is a foundational piece for everyone from total beginners to actual billionaires. Okay, but we gotta have our reality check here. As amazing as this all sounds, the S&P 500 isn't perfect. It's not a magic bullet, and it's super important to understand the downsides and the trade-offs you're making. So you've got the pros on one side, right? Broad diversification, crazy low cost, strong historical returns. But on the other side of the coin, you've got some cons you really need to know about, like being concentrated in a few big names and having zero international exposure. Let's dig into that.
So, one of the biggest issues right now is concentration. Because the index is weighted by size, the biggest companies have the most pull, and I mean a lot of pull. Right now, the top 5 or so companies, most of them in tech, make up something like a quarter of the entire index. So if those few stocks have a bad day, the whole index feels it. You're less diversified than you might think.
And it's got some major blind spots. By its very nature, it's only large US companies. That means you get zero exposure to what's happening in the rest of the world's economies. You also miss out on smaller, more nimble companies that might be the next big thing. The S&P 500 is often late to that party, only adding a company after it's already gotten huge.
So here's the bottom line. For so many people, an S&P 500 fund is a fantastic core holding, an amazing starting point. But it's not the entire strategy. It's just not a complete, globally diversified portfolio all by itself. So the big question is, how does this incredibly powerful tool fit into your financial future? The S&P 500 really is a remarkable thing. It's opened up investing for millions and has been a massive engine for wealth creation. But now, you know how it works. You know its amazing strengths, but you also see its limitations. And that knowledge is the first, most important step in making smart decisions for your own money.